If you are 58 years old and earning $95,000 a year, you probably think you understand how your tax works. You clocked in every fortnight, watched the payslip, and figured tax is tax. But the cake layer model you have used for 40 years is about to stop applying to you, and most people do not find that out until the numbers are already locked in. Here is the shift nobody explains properly. Most working Australians believe that earning more always means paying more, in a straight line, no exceptions. But once you land in what I call the retirement red zone, ages 55 to 65, the rules do not just change, they flip. Money that used to be taxed at your top rate can become tax-free. Money you thought was safely under the radar can suddenly attract a surcharge you never had to think about before. There is a real number sitting at $210,000 in combined income, where a surcharge can start clawing back part of your bill, even after you have stopped working full-time. And there is a mechanism called the TTR earnings exemption that can hand you back money you are currently sending straight to the ATO without even realizing it. None of this means you have been cheated. You have been using a map built for someone starting their career at 30, not someone standing near the finish line at 58 or 62. The map has not been updated. You have. In the next section, I am going to show you the retirement tax map and the exact number that decides whether you are about to lose part of your income to a surcharge you did not see coming. If you are between 55 and 65 and you are tired of quietly handing extra money to the ATO before you have even retired, hit subscribe because we are going to walk through these final working years together. I have watched this happen to people right before retirement more than once. They assume their tax situation stays exactly the way it always has, right up until the day they stop working. It does not. For the financial year that started on the 1st of July 2026, the tax-free threshold sits at $18,200. That number alone does not tell the full story for someone your age. Once you add in the seniors and pensioners tax offset, your effective tax-free threshold can climb as high as $35,000 to $40,000, depending on your circumstances. That is money the standard bracket chart never shows you. Think of your income in buckets, not one flat rate. The first $18,200 sits in a bucket taxed at 0. The next slice, from $18,201 up to $45,000, sits in a bucket taxed at 15%. Everything from $45,001 up to $135,000 sits in a bucket taxed at 30%. Your income fills the first bucket completely before a single dollar spills into the next one. Here is the trap. As wages rise with inflation, more of your income spills into the 30% bucket or higher, even though your actual buying power has not improved at all. This is called bracket creep, and it happens quietly, one pay rise at a time, without anyone sending you a letter about it. It is a bit like watching your council rates notice or your electricity bill climb a little higher every single year, even though your street and your house look exactly the same as they did the year before. Let me walk you through the numbers on $90,000 of income. The first $18,200 is taxed at 0. The next $26,800, taxed at 15%, comes to $4,020. The remaining $45,000, taxed at 30%, comes to $13,500. Add those together, and you get $17,520, plus the Medicare levy at 2% of your income, another $1,800. Your total bill lands at $19,320. It is not that you are bad at math. It is that this system is built to stay invisible until you are already past the point where changing your strategy is easy. There is another piece of this worth knowing before we move on. The rate on that middle bucket, currently 15%, is legislated to step down again to 14% from the 1st of July 2027. That is not something to plan your whole strategy around on its own, but it does mean the bucket system itself keeps shifting under your feet year after year, even without you doing anything differently at all. But here is what does not get highlighted enough. Once you turn 60, these same buckets start to leak, and for once, they leak in your favor. Something structural changes the day you turn 60, and almost nobody explains it clearly. Before that birthday, every dollar you draw from savings or investments gets taxed under the normal rules. After that birthday, a withdrawal from a tax super fund can come out completely tax-free. Take out $50,000 from your super at 61. And according to MoneySmart, the government's own consumer guidance service, that $50,000 does not even count as taxable income. Compare that to $50,000 earned from a part-time job at the same age, which gets taxed exactly like a normal wage. That difference is not a loophole, it is the design. Superannuation was built as a tax-preferred savings vehicle specifically, so that by the time you access it, tax has already effectively been paid along the way, mostly at 15% inside the fund itself, rather than at your full marginal rate. None of this kicks in automatically, and it is worth knowing what actually has to happen first. You need to have reached what is called your preservation age, which sits at 60 for anyone born after the middle of 1964, and you generally need to have retired or met another condition of release before the fund will release the money. Once that box is ticked, the tax-free treatment applies to the whole withdrawal, not just a portion of it. Once you understand this, you can think about your money as coming from three separate streams. The taxable stream is anything like part-time work, rental income, or investments outside super, and it gets taxed the normal way. The tax-free stream is anything drawn from super once you are past 60, and it does not add to your taxable income at all. The tax offset stream covers things like the seniors and pensioners tax offset, which can shave real dollars off whatever tax you do owe on the taxable stream. I used to tell people the secret to paying less tax near retirement was chasing deductions, keeping every receipt for work boots, or claiming a few cents an hour for a home office. I was wrong, or at least I was only looking at a small slice of the picture. For someone in their early 60s, a $1,000 deduction might save you around $300. Getting your income mix right between taxable and tax-free streams can be worth 10 times that without a single extra receipt. Here is what that looks like side by side. A 59-year-old still working full-time earns $80,000 in salary, all of it taxable, and ends up paying roughly $16,000 in tax and Medicare levy combined. A 61-year-old brings in the same $80,000 total, but structures it as $40,000 in part-time salary and $40,000 drawn from super. Because half of that income is tax-free, their total tax bill drops to somewhere around $4,000. Same $80,000 coming in the door. Roughly $12,000 more staying in their pocket at the end of the year. That is not a trick. That is what happens when the definition of income itself changes for you. And most people never adjust their thinking to match it. There is one number, though, that does not care whether your super is tax-free. If you miss it, the ATO can still add a surcharge to your entire bill, super or no super. Let me tell you about a couple I will call Dave and Chris, both 63, both fully retired. Between super drawdowns, some investment earnings, and a small pension from Dave's old job, their combined assessable income for surcharge purposes sits at $215,000 a year. A few years earlier, they had cancelled their private hospital cover to save what looked like an easy $4,000 a year. On paper, that felt like a sensible trim to their budget. Here is the part they missed. The Medicare Levy Surcharge applies once your income crosses a set threshold and you do not hold private hospital cover. For the 2026-27 financial year, That threshold sits at $105,000 for a single person and $210,000 for a couple. Dave and Chris are $5,000 over the couple threshold, which puts them into the first surcharge tier, an extra 1% on top of their normal Medicare levy. 1% of $215,000 is $2,150. That is not a one-off. That is every single year, for as long as their income stays above that line and they stay without cover. Now compare that to the cost of keeping a basic hospital policy, even one with a high excess, which can run around $2,000 a year for a couple. Keep that policy, and the surcharge disappears completely. Dave and Chris would have paid $2,000 for cover instead of $2,150 in extra tax, saving $150 and actually having hospital cover in place if either of them ever needs it. This is not about scaring you into buying insurance you do not need. It is about knowing where the line sits. Single threshold $105,000. Couple threshold $210,000. If your combined retirement income sits anywhere near that number, working through the maths on keeping even a basic policy is worth doing properly, because the alternative is not a deduction you can claim your way out of. There is no receipt that makes this one go away. One detail that surprises people is how little cover is actually required to clear the surcharge. It does not need to be a gold policy loaded with extras. A basic hospital-only product that meets the government minimum standard is enough, which is exactly why the maths so often favors holding one, even a bare-bones version, once your combined income sits near these thresholds. These thresholds also move most years, so it pays to check the current figures for your income year rather than assuming last year's numbers still apply. But there is a way to lower how much of your income the ATO counts toward that threshold in the first place, and it starts well before you actually retire. For the financial year that started on the 1st of July, 2026, the concessional contributions cap sits at $32,500. That is the maximum you can put into super each year and have it taxed at roughly 15% going in, rather than at your normal marginal rate, which for many people your age sits at 30% or higher. Most people never use the full cap. If your total super balance sits under $500,000, the ATO lets you carry forward unused amounts from the last 5 years and use them all in one go. That is not a small technicality. If you have been under-contributing for 3 years running, you could be sitting on a genuine $90,000 tax shield, ready to use the moment you have the cash to put toward it. Here is how that shield actually builds. Say your employer only puts in the compulsory amount, well under the $32,500 cap, leaving a meaningful gap unused every year. Leave that gap sitting there for 3 years running, and the unused amounts stack up quietly in the background, on top of whatever cap applies to you this year. Sell an investment, receive an inheritance, or free up cash from another source, and you can direct a much larger sum into super in a single year, while it is still taxed at the concessional rate, not your top marginal rate. Here is the honest pushback I hear constantly. But Bob, I do not have $90,000 sitting around to shove into super. Fair enough, almost nobody does. That is where the downsizer contribution comes in, and it is one of the only moves the ATO lets you make that ignores the usual caps altogether. If you are 55 or older and you sell a home you have owned for at least 10 years, you can put up to $300,000 per person, so up to $600,000 for a couple, straight into super from the sale proceeds. It does not touch your concessional or non-concessional caps at all. If you are already planning to downsize anyway, for a smaller place or lower maintenance, this turns a lifestyle decision you were making, regardless, into a genuine tax and retirement income boost. None of this requires you to find spare cash you do not have. It requires paying attention to which lever fits your actual situation, whether that is catching up on unused caps slowly over a couple of years or using proceeds you were always going to receive from a home sale. There is one more layer to this, and it has nothing to do with contribution caps. It is about what happens to whatever is left in your super when you are gone, and it catches almost everyone off guard the first time they hear about it. I hear some version of this every week. Bob, why should my kids pay tax on money I already paid tax on my whole working life? It feels deeply unfair, and honestly, your instinct on this one is correct. There is a real tax that can apply to superannuation death benefits, and it catches people off guard because most of us assume that once tax is paid, it is paid, full stop. The mechanism works like this. Superannuation has what is called a taxable component and a tax-free component built up over your working life depending on how contributions were made. If your adult children inherit the taxable component of your super, they can be taxed on it, sometimes around 17%, including the Medicare Levy component, even though every fortnight of your working life you already had tax taken out along the way. This tax does not land on every beneficiary the same way. A spouse or a dependent child generally receives the payout completely tax-free, no matter which component it sits in. It is specifically adult children who are financially independent, the group most people leave the bulk of their super to, who fall into the taxed category. That is exactly why it catches so many families off guard. There is a way to shift the balance between those two components without needing a single extra dollar called the recontribution strategy. In broad terms, it means withdrawing an amount from your super once you are eligible, then recontributing it as a non-concessional contribution within your caps. That withdrawal and recontribution can convert part of the taxable component into the tax-free component, so less of what your children eventually inherit sits in the portion that gets taxed. It is a timing and paperwork shift, not new money. I remember sitting with a bloke named Gary in Gosford who was so angry about this that he nearly refused to put another dollar into super at all. He felt like the system was designed to take a cut, no matter what he did. Once we actually sat down and went through the real numbers together, line by line, he could see the recontribution approach would protect a meaningful chunk of what his kids would eventually receive. He was not wrong to be frustrated. He was just missing one tool that would have solved the exact thing that was bothering him. Tax in your 50s and 60s is not one flat cost sitting over your whole life. It is a series of buckets, and your job from here is simply to move more of your money from the taxable bucket into the tax-free bucket, using the switch that opens at $60 and the $32,500 cap available to you each year. You have worked for 40 years to get here. The system genuinely is complicated, more complicated than it needs to be. But once you know where the off-ramps actually sit, you get to keep a meaningfully larger share of money that was always yours in the first place. None of this needs to happen all at once, and you do not need to restructure your whole plan the week you hear about it. Small moves, made at the right time, add up the same slow way your super itself has quietly compounded over the decades. If this helped you spot a gap in your own plan, subscribe, because the next thing we are walking through together is exactly how the age pension assets test works, and where most people accidentally trip themselves up.